Hello, everyone. Hope we're all doing well. Sorry, there was, I think, a bit of an issue with the Zoom coming in, but I think we're all good to go now. I'm not sure if you'd like me to wait a couple minutes or should we just get right started?
Hey, morning, Mike.
Hey, good morning, Harry.
Don't mind asking, how many people show up right now?
Looks like there's about 20 on the call.
Great. Morning, everyone. Can I just do an ad? Oh, sorry. Let me just mute I got two meetings going on. Sorry about that. 不好意思，Kelly 姐，我这里 mute 一下，不好意思，sorry。So I just want to make a trying to advertise. Anybody, at Burnaby office in like Vancouver office. Remember, I do have an in-person session Tuesday. That's just in person, okay, from 1 to 3 p.m. at the office. I post on my WeChat. If you guys don't have my WeChat yet, let me know. So I will announce in the future a lot of events or sessions on the WeChat group, also with email as well. So that's it. And the topic is going to be leverage concept. So if you guys can come over, check it out. I won't disappoint you guys. Okay, that's it. That's my ad. Michael, back to you.
Perfect. Well, thank you so much, Harry. I appreciate that. We'll go ahead and get right into it here. So I'm just going to get the presentation up and running. There we go. Perfect. Just 1 second here. Perfect. Okay, I think we're going to go ahead and get started, everyone. And I think we are going to be doing some in-person sessions a little bit later on. I think starting next month as well. So it'd be wonderful to have the opportunity to connect with many of you in person. Wave Financial had a phenomenal year last year with IA. I'm hoping to capitalize on the growth as well and continue that through 2025. We're going to cover a few different things today. So we'll do a little bit of a market update to start. We'll touch on a short review of the contracts. Then we'll sort of proceed into a little bit of pardon me, a few strategies just around RSP season, particularly with RSP loans. We are offering a 50 basis point discount on RSP loans issued between now and January 31st. So that started in late November. There would have been a few notifications from head office, but again, do want to advertise that a little bit more to everyone as well. Again, a 50 basis point loan discount from now until January 31st. So we'll touch on that in a bit more detail here as well. And otherwise, we'll go ahead and get right into it here. So do want to just start off with a little bit of an update of kind of where we've been and where we're going. 2023 and 2024 were both exceptionally strong years for the market. If we take a look in Canadian dollars, which is basically this column right here, we can see the Nasdaq had 2 years back to back at over 40% returns, which is extremely impressive. We also had, of course, the S&P 500 returning more than 20% 2 years back in 2 years in a row. This number is obviously a little bit higher in Canadian dollar, which we'll touch on momentarily. And we also, of course, had a very good run out of Canada as well, just under 10% in 2023 and just over 20% in 2024 as well. So overall, two very, very strong years back to back for the market. So I've been pretty happy with sort of what we've seen over the last little bit as well here. Looking forward to 2025, we have a kind of thought process right now that it will still be a relatively good year. We don't think, obviously, it'll be on the same extent that we've seen from the last 2 years, largely due to the fact that things have gotten a little bit hot, but we'll touch on that in a little bit more detail. US to Canadian dollar obviously fell significantly last year, down almost 8%. And of course, gold rose significantly as well. So definitely a few different themes sort of going on over the last little bit here, and definitely some things we're going to talk about in a little bit more detail through this presentation as well. Starting off kind of where we've been on the year, so far it's been a relatively positive start to the year. You can see most of the major indexes a little bit flat as of this chart, which is last week, but as of right now, we're slightly positive on the year, up about 1.5-ish, 2%. Basically, the overarching consensus is we should still have a relatively good year out of Canadian and US equities. Bear in mind, of course, it is really just a forecast, so take it with a grain of salt. It doesn't really mean anything. We don't expect there to be anything like the last 2 years. They were largely driven by the rally in artificial intelligence, which drove tech stocks up considerably. That's obviously why the Nasdaq was so heavy, was so much higher than the other indexes as well, because Basically, 60% of your money goes into the seven major tech stocks, so Facebook, Amazon, Apple, Netflix, Google, etc. AI is going to basically be a little bit of an interesting story over the next couple of years. It's going to come down to, do we think you'll be able to monetize it? Because right now, per dollar of spending on artificial intelligence is actually revenue negative. I believe it's 60% of iPhone users with the iPhone 16 think Apple Intelligence is not very useful. Microsoft is ultimately going to have to decide if they can get people to pay $30 a month for Copilot, which is their AI add-on as well. So it will obviously revolutionize certain subsections of the economy. So coding, certain processes and things like that. But is it actually going to be able to be monetized? That's going to be the interesting thing. There's sort of two schools of thought. One is, of course, it could be like the dot-com bubble where everyone invests heavily into it and then the consumer doesn't see a lot of value in it and it doesn't really go anywhere. Or it could be a fourth industrial revolution. So we don't know exactly how that's going to work out just yet. We'll find out in the next couple years. The S&P 500, we have started to see a little bit more broad-based growth. So you are starting to see financials, materials, industrials, certain other sectors within the S&P that are not tech related start to move a little bit more as well. And the TSX Composite is considered pretty attractively priced now as well. So overall, we think that's a pretty good thing going forward. We do think Canada is a little bit better valued than the States, but overall, there's quite a, so far the outlook is, cautiously optimistic, but optimistic more than anything. The kind of main things we do want to keep an eye of and what will be the themes through 2025 here. First off is going to be interest rate expectations as well as spending. Basically, kind of the thought process right now is we think the US market may not cut interest rates as aggressively as they thought. There is sort of a projection to have maybe one cut before June, but it looks like there's actually a pretty reasonable case for the US market to actually hold interest rates this year. So market may have potentially overpriced in cuts, and now we might potentially be seeing maybe a flat to no cut year from the US. Again, this is a fluid story and changing, on a weekly and monthly basis as more information comes out, but potentially may not see a lot of cuts out of the US. You've also seen US bonds and treasuries rally quite considerably. This is largely due to the fact that you could potentially see a little bit of a return toward inflation, and of course, a little bit more consumer, or not consumer spending, government spending from the Trump government as well. So overall, the states may not see the cuts that they were expecting this year because the US economy has been extremely strong. Kind of what we're thinking so far in terms of what's going to see out of the US Federal Reserve as well here. Again, kind of the thought process more than anything else is the US Federal Reserve is projected to keep rates higher than Canada here. So as you can see, the lending rate in the US is 175 basis points higher than it is in Canada. They've been much slower to cut rates, so they're not cutting at the same rate that we are. And the expectations right now are you might see one more cut out of the States by the summer. Canada might potentially continue to cut going forward, depending on how the data does come out. This is could potentially be a difficult thing for trade. As typically the U.S. and Canada, Federal Reserve and Bank of Canada usually follow each other quite closely. So we don't really want to have too big of a divergence because it can create a bit of a gap in GDP. And we're already dealing with a weak dollar relative to the US. I'm sure many of you have seen if you've tried to go to the States. And we might also, of course, potentially see some form of tariffs. We don't really know what exactly. But basically, we are starting to see a divergence between the two, which may be an issue going forward. US stocks right now are considered extremely expensive, or not extremely expensive, but quite expensive. You can see here on a PE ratio, it was really high coming into the 2000 tech bubble crash. That's when tech stocks got way out of control. We also saw just before COVID, things got quite expensive. So things are actually on a historical basis extremely high right now. So we're going back to 1950, you're paying per dollar of earnings a very high premium now for the US. Basically, kind of where we are sort of looking over here at the Shiller ratio sitting at about 37, which is kind of right in here. Your expectation over the next 10 years out of US stocks would in theory be low single digits at this price point, right? Now, to be fair, this is really just a metric of looking at things. It's not a crystal ball. We do think the US is expensive right now. It's not drastically expensive, but it's expensive. So you are potentially getting better value putting money to work in Canada or other parts of the world. Not saying that you shouldn't own the States. We're still thinking of a reasonable overweight to the States. But just remember, per dollar of earnings right now in the States, you are paying a premium. A lot of the tech stocks are priced almost for perfection. So any drop in their performance or if they miss earnings, it will negatively impact them as well here. Again, just kind of on an asset allocation outlook, we think fixed income is not going to do as well potentially as we thought originally, again, due to the fact that rate cuts may be slower than expected, particularly out of the States. We think the outlook for equities is still pretty positive. Canada, of course, looking a little bit more appealing than the States, but again, still should have some money in the States. We can always want to have a diversified portfolio. Um, we think the US dollar will continue to remain strong against the Canadian dollar. That'll probably be an ongoing trade. And we think gold has run up a little bit too high, so you might potentially see it pause or slow down a little bit. But overall, again, outlook is, I would say reasonably positive. It's a little bit expensive out there, but again, the outlook kind of in the short to midterm is still largely positive for equities at this point. Switching gears a little bit towards segregated funds, just very quickly, I always like to run through this illustration because this is how I consider presenting segregated funds to clients. We always want to talk about how do we present different investment options to clients, right? So you might sit down with the client and say, what types of investments are you currently familiar with? And the client might say, well, I'm familiar with GICs and bonds, and those types of investments have guarantees on them, right? But there are disadvantages to highlight. Low rates of return, your money's locked in, and it's 100% taxable at your marginal tax rate if it's a non-registered investment. Alternatively, on the right side of the screen, the client might say, I'm also familiar with mutual funds and stocks, but there are advantages of that as well. Potentially higher returns versus the left side of the screen, as we know the stock market has outperformed the bond market historically. Liquidity, if I need to get out of my mutual fund or stock, it just usually takes 2 business days, and I'm usually taxed at a rate of 50% or better through capital gains tax or dividend tax credits. But there's typically no guarantees involved with this type of investment. So where segregated funds come into the play, if I take some of the benefits of the right, some of the benefits of the left and put them together, that's really where we find a segregated fund. Segregated funds have return profiles similar to mutual funds, liquidity, potentially better tax situations, guarantees around maturity and death benefits, potential creditor protection, and the ability to bypass probate as well. So a client might say, if seg funds are such a good investment, how come I've never heard of it before? The reality is the average person has their banking needs dealt with by a bank or credit union, and they're not licensed to sell insurance at the branch. So why would they ever talk about something they're not licensed to sell? So this is again the value of dealing with an independent advisor. You're not dealing with any particular product provider or type of company. You just sit down with the client, you find out what's the best fit for them, and ultimately you work with that. The other big benefit with seg funds, of course, is estate planning. Now, if I pass away in BC and I own assets like this, mutual funds, savings bonds, property, money in a bank account, when you pass away, you go through the probate process where the government calculates the value of your estate for tax purposes. They are going to charge you provincial tax because essentially it's considered a deemed disposition on death of your assets. And they're also going to charge you a probate fee of 1.4%. This process on average usually takes 3 to 6 months, at which point you book an appointment with the court to pay your final taxes. If the person that passed away owes anyone money, debts or creditors will go after the estate to try to get whatever they're owed. And as people find this process quite complicated, they may hire lawyers, executors, or accountants to assist in the process. They, of course, take time and cost a lot of money. After you've gone through this entire ordeal, your beneficiaries will receive the assets roughly 12 to 18 months later in BC. Now, if you die with $50 in your bank account, it could be done by the end of the week. If you have 3 properties in a business and one kid says he deserves more than the other for whatever reason, 2, 3, 4, 5, 6 years is not out of the question. Now, alternatively, any assets held in a segregated fund contract with a listed beneficiary will have the assets paid out roughly 7 to 10 business days after we receive the paperwork. I like to say 2 to 3 weeks start to finish because you do need a death certificate and you have to fill out a few forms and get them to head office. But we're not dealing with this 3 to 6 month delay down here. We can bypass probate as long as we have a designated beneficiary set up. If set up properly, we can potentially have protection from debts or creditors. Oops, over here. We don't need to hire lawyers, executors, or accountants as they take time and cost a lot of money. And of course, we're not dealing with this 12 to 18 month delay at the top as well. So it's a much simpler, much cleaner estate settling process as we go through it. We're not dealing with any of the hassle if your children have mortgages, student loans, various other debts. It's a much easier way to go through it as well here. Now, we do want to talk about seg fund business. Really, there's 3 main contracts. The first is a standard 75-75 series. This is really for clients who have the objective of growth. There are no resets available, and it is the lowest fee option. This is really your mutual fund equivalent if you hold an insurance license and not a fund license. You have a 75% guarantee at death and maturity, which is always present. However, the maturity guarantee is December 31st of the year the annuitant turns 100, so I would functionally consider it no maturity guarantee, right? The death benefit is always present. Again, I would really consider this sort of your main investment option or mutual fund equivalent if you're an insurance licensed agent. The MER difference relative to mutual funds is very small. You have a full range available to you. So this is, and you have all of the benefits of segregated funds as well. Now, where IA shines kind of on a contractual basis is our 75-100 series. So the second number is the 100% death benefit, meaning in the event that the client passes away, 100% of all of the initial invested premium is guaranteed at 100% to the beneficiaries in the event of death. Again, for the purpose of estate planning, you also have one reset per year on the death benefit up to age 85, and IA will also accept and guarantee deposits up to age 85 as well. This is industry leading as the rest of the industry cuts off at age 80, or some go to 85. And there's one carrier that goes past us to 90, but they will only offer you a very small shelf of fixed income and balance funds. IA offers the entire segregated fund shelf with no equity restrictions up to the client's 85th birthday with resets. So contractually, I would feel comfortable telling you this is the strongest contract in the industry if you're looking at maximizing your estate, which is what most people would be considering with the 75-100 contract. Now, in terms of resets, if I invest $100,000 here, in the preceding 5 years, it grows to 140, I can then set up and do a reset with my client, and I now locked in growth of $140,000 in the event of death. Now, if we have a scenario where the market goes down, goes down, goes down, and my client passes away with $108,000 in their account, what happens? $108,000, which is the current market value of the contract, gets paid out to the beneficiaries because that's the money in the account. That's easy enough. Then IA would kick in a $32,000 insurance top up to bring the client whole at 140. So I started with 100,000, I passed away with 108, but because I had a 75-100 contract and resets, my beneficiaries will receive $140,000 in this example. So again, you can do this reset once per calendar year, either manually or automatically on a date of your choosing. We have both options. There's no underwriting involved. Large cases, sometimes we do require approval. I've never seen one get rejected, but they do require approval. And again, you have access to all of our segregated funds within this contract as well. There is no underwriting, so if a client is uninsurable on the insurance side, it fits quite well over here. You have somebody that is a single breadwinner and they want to have a guarantee on their investments. Whatever the scenario is, this can be a very good fit for them in that case. Margaret has asked, are there any CE credits for this session? Yes, Margaret, there will be CE credits offered. And can you switch from 75-75 to 75-100? Yes, you can. It would just be the standard switch form. Now, to give you a quick example of where segregated funds show their value over mutual funds, here's an example of how I can get 3 death benefit resets in 1 year. So I make an initial deposit April 1st, 2009 of $100,000. I've now set a death guarantee at 100 grand, right? So if my client passes away, they cannot get less than $100,000. Now I did this April 1st, 2009. In the preceding 8 months, my investment rises 37% in value. This is coming out of the 2008 financial crisis. This is a very cherry-picked example. I completely appreciate that. Head office put it together. But for illustrative purposes, I then choose to do my 2009 calendar year reset, December 31st, 2009. I lock in a gain of 37%. Now my death floor is $137,000. The year rolls over. It's now 2010. In the first quarter of 2010, the market rises another 5.5%. I choose to do my 2010 calendar year reset April 1st. This is now how I've essentially increased my death floor from 100 grand to 137 to 145 in the span of 12 months, right? So this is a strategy you can employ, particularly on the estate planning side of things, that can be very appealing for the right client situation. Again, I know this is a very cherry-picked example. Let's assume you make 8% a year, but this is an option to consider as well here. Last contract available, I'm not really going to spend a lot of time on, is a 100-100 series. This has a 100% guarantee at death and maturity with the ability to set a maturity guarantee 15 years out if you choose. What's appealing about this type of contract is it really only fits for a client that's a GIC refugee. If they say, look, I don't care what the fee is, I want to have a 15-year guarantee on my assets, a 100-100 series can fit in that case. You do pay a very high MER. You have 4 resets per year on the death benefit and the maturity guarantee. I really look at this contract as being overinsured because you're paying, I would say, too much for things you don't really need. But that being said, for the right client scenario, we do still get some money here. So it's something to consider because we are one of the last carriers that actually offers a true 100 series, 100-100 contract. Again, the value of segregated funds versus non-registered assets for mutual funds is significant. This is where we get a lot of big business because typically if somebody sells a house in Vancouver, they might get $1.5, $2, $3 million for it. Chances are they're older and it's going to go non-registered, right? So what are the advantages of segregated funds over mutual funds or stocks? Potential creditor protection, which is very appealing for entrepreneurs and professionals. Ability to and just to clarify that that's only for personal assets, it is not for corporate assets. The ability to designate a beneficiary for estate planning purposes. Mutual funds or stock portfolios cannot do that. If you have $1 million stock portfolio, the whole thing is getting stuck in probate, right? If you have it in a seg fund contract, it'll bypass. You have quick settlement of the estate in the event of death, simplicity in tax reporting, possibility of avoiding probate fees. Why does it say possibility? You have to designate a beneficiary, right? So if you leave it blank, the default is the estate. And it's also confidential, right? So if you're leaving $1 million to your kids, you may not want anyone else to know that you're doing that, right? So this does not become part of the will, does not form part of public record. Essentially, basically the only people that would know would be the owner and the beneficiary of the contract. You also have capital protection on death through the 75-100 contract and resets. And again, accept and guarantee deposits up to the client's 85th birthday, and of the entire segregated fund shelf available as well. A couple questions. Oh, so Margaret has asked, is there a tax issue to switch from the 75-75 to 7500? That's a great question, Margaret. The answer is no. So as long as you just change the guarantee, so if you go dynamic global dividend 75-75 to 7500, that is not considered a disposition. However, if you change the funds on a non-registered, that is always a disposition. So just to be clear, if you're just changing the guarantee, it is not taxable. If you change the underlying funds as well, that is always taxable. So just want to clarify that. So guarantee switch, not taxable. Fund switch is taxable. So just want to make sure everyone understands that as well. Examples of costs here. So simply put, basically, if we have a segregated fund contract versus a mutual fund contract, you do have a higher MER. But on death, we always need to look at the net value difference. So with mutual funds here, I made the same investment mutual fund and seg funds 15 years ago. Mutual funds, right? Clients has more money on death because they have a lower MER, but what happens? We have probate fees of 1.5%, professional fees, right? Executors, accountants, so forth. Executors on average take 2 to 3% of your estate value. They can take as high as 5 if you do it with a bank. So it's something to consider. And you also have redemption costs of potentially on DSC as well here. So going through the estate process, we actually lost roughly 4%, right? Going through that process. So yeah, excuse me, roughly 4% going through that process, and that's before we hit tax. That's just fees. Seg funds, on the other hand, 209 that we started with, no probate fees, no professional fees, no executor costs, no redemption costs. 209 that we start with is the 209 that we finish with, and this works out to a net difference of almost 5% over the mutual funds. This is also paid out in 7 to 10 business days versus 12 to 18 months on a non-registered mutual fund portfolio as well. Now, in terms of what we offer kind of on the fee side of things, we do offer 2 tiers of high net worth pricing, one at $300,000, one at $500,000. What's interesting with IA is if you buy our internal products, so the ones managed by Clarington, you will get a discount, a steeper MER discount than you will with third-party funds like Fidelity. And the Prestige high net worth pricing will go as high as a 62 basis point reduction on there as well. So it's a pretty attractive fee reduction. And what's unique about IA is we actually have to just do it at the household level. So once you get a family in a household up to $300,000 in total assets, they're actually allowed to take the discount outside of the household and share it with family members. So if you have, son in Alberta with 50 grand, grandparents in Ontario with 200 grand, nephew in Newfoundland with 60 grand, you're actually able, once the first household in BC is at 300, to link all of the outside assets of family members into that first household, so they get a discount. So the benefit of it is you're able to grow your business, right, by generating referrals, and they're all able to get lower MERs on their investments as well. So it kind of becomes a win-win for everyone. And again, that's something unique to IA. We count segregated funds, GICs, savings accounts toward the assets, and we also count corporate assets as well, as long as the grouping owner is the same. Now, when we do want to partner with IA for seg funds, what do we offer as a carrier of choice? We offer over 91 segregated funds with a wide variety of managers. So as you can see on the right side of the screen, Clarington, which is part of IA, Fidelity, Dynamic, BlackRock, PIMCO, etc. Some of the largest money managers in the world. It's a very large and deep shelf. So we have index funds, ESG funds, dividend funds, growth funds, small mid cap, real estate, healthcare, technology, portfolio products, really anything you could ever need from an investment standpoint is available on the shelf. We also offer prestige pricing, which I just discussed, industry leading 75/100 with all 91 segregated funds available, and also automatic death benefit resets up to the client's 85th birthday as well. So again, something to consider there. We also have Evo Savings and Business Tracker and a full range of guaranteed solutions as well. Now, if you're uncomfortable choosing your own investments, we do have pre-built portfolios for you. Basically, you would do your investor profile with the client, score prudent through to aggressive, and we would essentially create a portfolio for you there. I will email this out to everyone afterwards, so don't worry about writing it down. But these are basically just pre-built portfolios should you want to go and not comfortable choosing your own investments. We also have a lot of custom options available as well, so we can talk about that momentarily, but I will email this out to everyone afterwards. The other thing I do like to talk about right now is what's going on with gold and silver, because this has been quite topical as well. Gold went up quite considerably. This is a comparison of gold and silver versus the S&P 500 and the Dow Jones. As you can see here, on a 30-year basis, gold and silver typically significantly underperform the broad market. So as you can see here, on a 30-year basis, they're returning roughly less than half of what you get out of the S&P 500, and this is not including dividends. Gold and silver typically are not very good investments for a few reasons. One, they tend to underperform the broad market pretty consistently. You're not paid any interest or dividends while you hold them because they're just metal. You typically have to store them at a bank or some type of depository because you're not going to keep 50 grand in gold under your bed probably. So there's a cost to do that as well. Gold and silver outperformed after the 2008 financial crisis because there was some concern that we weren't going to use money anymore and you were going to go to Abbotsford and trade silver coins with a farmer to get milk and eggs. Obviously didn't happen. So kind of when that sort of fear abated, they collapsed and the market took back off again. It is always seen as a good hedge against inflation, but there's something to consider on that. Gold is really only a good hedge versus cash. So if I have $100 in gold and I have $100 in cash, over the long term, yeah, the gold will be better than the cash, right? Because cash will lose value, the gold will appreciate. But if you compare gold to real estate, the S&P 500, the TSX Composite, so on and so forth, typically a very significant underperformer over the long term as well. There have been a couple of things that have driven it up over the last few years. One has been the return of inflation after COVID. So again, gold is seen as a hedge against inflation, so that's fair. Central banks around the world have gone into a net gold buying cycle. So a lot of the last 5-10 years prior, they were selling gold reserves down. They've now gone the other way and started to become a net buyer. So there's demand from Federal Reserves around the world. And there's a lot of geopolitical risks. So the war in Russia and Ukraine, what's going on in the Middle East. So people tend to go to gold as a flight to safety. However, long term, again, it does, if you take a look at the charts, underperform traditional investments typically quite a bit. So not saying that you don't want to own it. I mean, if you want to have a portion of your assets there for, whatever reason, it can make sense. But again, over the long term, not typically a very good performing investment. And you can actually see here, most of the return of gold and silver really came in the last 3 years. The 30 years prior, you didn't really see, or sorry, the 26 years prior, you didn't really see a whole lot of action from them. So something to consider there as well, but I thought kind of a topical thing to touch on. Another thing to touch on is the regulatory update with total cost reporting. So beginning in early 2027, regulators are basically going to require full cost reporting on investment products in Canada. So this will impact client 2026 statements. This will impact mutual funds, ETFs, segregated funds, basically all investment products. You'll have to provide a detailed breakdown of what goes to the dealer, the investment company, the advisor, MERs, trading ratios. I think taxes are built into there as well. So basically, essentially, it'll impact all investment products come early 2027. Basically set in stone to impact the MFDA and mutual funds. It's not 100% guaranteed for seg funds yet. However, we are at IA, as an example, basically preparing for it to happen at the same time. So that's kind of what our thought process is on it. To give you a quick breakdown of it here, if I invested money with ABC Financial, basically put, it's going to say, what are my costs to actually invest my money? So it was $815 last year. $120 of that went to the dealer. So this could be way, as an example. It costed $645 to have IA or Dynamic or Fidelity manage the money. Were there any redemptions or dealer fees? So what was the cost that was paid to the investment company? What was my total cost to invest my money? That'll be stripped out. And it'll also say how much money did I pay my financial advisor. So in this example here, I paid my advisor $462 a year. So to give you a quick example, client has $1 million portfolio, 2.5% MER. It'll say $10,000 went to IA to manage the money. $10,000 went to your advisor and dealer to provide financial advice. And the remaining 0.5% was a mix of taxes, trading expense ratios, and whatever other little fees kind of make up the difference. So this is coming down the pipe in the next year and a half. So something to be mindful of here. A few ways we've looked at kind of mitigating that based on more of a focus on fees as well as advisor demand is we have launched 4 new index funds. So basically 3 equity options. So the US equity index, which is the US total market. This is basically all 3,500 publicly listed companies in the States. So the BlackRock US equity index with us right now is the S&P 500, so the 500 largest companies. This is basically the US total market, which is 3,500 companies, so all of them there as well. We also have the Indexia Canadian Equity Index. This is full exposure to Canadian equities with a 10% capped weight. And of course, you have the MSCI Global Index with no Canada. So basically 3 indexes available to your clients here, starting at MERs of 2.14%. And then on the fixed income side, we have the Canadian Universe Bond Index at 1.89%. Now, if you're doing an upfront commission option such as CB5 or CB3, you are paid a full upfront commission on these products, so that's still the same. However, the thing to be mindful is you do get a reduced trailer by about 25%. Simply put, because it is an index product, we have to cut our margin on it. You have to cut yours to get the fee down. So again, your upfront commission, if you choose, is the same as the other options. However, your trailing commission is reduced by about 25%. So just kind of to be mindful of as well there. But so far, we have actually sold quite a bit of these. So again, very attractively priced MERs if you're looking for an indexed option with all of the benefits of segregated funds as well. Do also want to just quick point on fund manager changes. Basically, what I do want to talk about is Core Plus Bond. We recently brought Dan Janis over. He was a very large fund manager at Manulife, running the Strategic Income Fund for, I believe, over 15 years over there. He recently left Manulife to start his own firm, Agile Investment Management. And as such, we have been able to bring him over to IA to manage several of our bond options on the Clarington and segregated fund side. So he did take over Core Plus Bond on the seg fund side as well here. The story I like to run with this is simply put, continues to speak to the product and the platform that we've built at IA. They were able to attract world-class talent such as Dan Janis onto our platform as well here. So we're very happy to bring him on. And again, continues to speak to our success in the segregated fund market as we are the #1 carrier in Canada. 40% of all segregated fund business in Canada last year was done at IA Financial Group, which makes us the market leader by a massive margin. We are also the #1 carrier by both gross and net sales volume as well. So again, there is a lot of strength with us. Wave Financial, of course, has been a huge supporter this year, and we're hoping to continue that momentum through 2025 as well. Now, I do also want to talk a little bit just in the spirit of the season with RSP season and talk a little bit about loans and what we can offer there as well. So what I do want to talk about first of all is how do we approach a loan scenario with a client? So I'm going to give you an example here. I've got Bob Smith. He's 40 years old. He's a resident of BC. He makes 130 grand a year and his marginal tax rate is 40.7%. Okay. He has small RSP savings, lots of room available, and he comes to you as a client and says, look, I want to make an RSP contribution. I'm falling a little bit behind. I need to get something going here. He says, I've got $12,000 I want to put in my RSP right now. Can you help me do it? Okay. So there's 2 things we could do here to help Bob. So option 1 is we just make a standard RSP contribution, right? So you sit down with Bob, you go on Evo, you open an RSP, you contribute $12,000. Bob gets a tax savings of roughly $4,600 here, right, in tax savings. So, and we're going to assume $12,000 at 6, we're going to assume a 6% rate of return, invested for 25 years, works out to about $51,500 at retirement, right? So that's kind of an example of how we can go about this here. So this is just a simple standard RSP contribution. Now, option 2 is what if we take advantage of an RSP loan? What type of scenario can we do? Well, there's a formula we want to consider for going through that. So cash available for RSP times your marginal tax rate, and then 1 minus your marginal tax rate. This is going to provide us the amount of money we can take a loan out on and use the refund to pay down the loan to minimize the amount of payment we have to do and generate a maximum refund. So Bob's marginal tax rate, 40.7%. Run the formula here. He should be able to borrow about $8,236, and we'll go through why this makes sense. Now, if we essentially do the RSP deposit with no loan, right, Bob gets a deduction of about $4,600. Now, if he does the RSP deposit with loan, so $12,000 plus an $8,200 loan, he gets back about $7,800. Now, his monthly loan payment would be 5-year amortization would be $176 a month. Actually, this would be a little bit less because the rates have gone down since I last ran this. So an $8,000 loan at 9.45 interest with a 60-day deferral would cost him about $353, right? We're going to choose the 120-day deferral by IA, and we're essentially going to receive the refund by the government, and we're going to use the refund to pay the loan back. So $7,800 deduction, okay, less the loan value, less the less the 353 that we have to pay back here. So it's going to roughly cost Bob $776 to go through this process, right? So his deduction with the loan is $7,800, comes from up here. Okay, his RSP repayment, so we're going to assume he goes to pay the loan off immediately, right? We're going to assume he incurs 60 days of interest costs as well. So the cost to do this strategy is going to cost him roughly $776 to go through this process. But what does he gain from it? How does this impact his RSP savings? So Bob is 40 years old and has 25 years to invest to retirement. So if he makes a simple RSP deposit at 6%, $51,500, right, as we showed previously, if we assume he takes his $4,600 deduction, reinvested into the RSP at 6%, that could potentially make him another $20,000. So that gets him $72,300 at retirement. Alternatively, down here, right, if we make our $12,000 deposit plus our $8,300 loan, right? So that's 6%, that's $8,863, right? So we have to essentially factor in the fact that we paid the loan down with the previous option there. But essentially what we do is option 2 minus option 1, taking advantage of the loan, including repayment, gets us ahead by roughly $14,456. So this is a strategy we can employ to generate additional value off of an RSP loan. This, of course, depends on the client's situation, if the tax consequences make sense for them. I mean, a loan isn't necessarily for everybody, but it does make sense, of course, to take advantage of the strategy. So you get the loan, right? You generate the larger deduction, you use the deduction to pay back the loan, right? And then you're investing more money to start off with because you took advantage of it. So it's something we want to consider over here as well. So Bob essentially used his RSP loan to generate an additional almost $15,000 at retirement versus using a standard RSP deposit, and it only cost him about $750 to do it, right? So it's a strategy to consider here. When we do want to consider leveraging loans, the risk must be fully understood by the advisor and the client. So again, it is a leverage strategy and it is an illustration, right? So again, there's always risk with leverage, as we should know as advisors. Make sure you do your KYC or your client statement as well here. Advisor obligations, so you always need to consider the risks involved, do your profile financial needs analysis, so on and so forth. We do have an RSP loan guide, which has all of the details as well. Again, it is a quick and easy way to increase contributions to an RSP, receive a higher tax refund, and again, maximize tax sheltered savings with a higher potential retirement income as well here. Just kind of an overview of what we offer in terms of loans. Our minimum loan is $1,000, our maximum is $50,000. Repayment period is up to 10 years. Your interest rate will be determined by the amount of money you borrow as well as the repayment term. So again, as set here. So this is all available on our website, and I will email this out to everyone afterwards as well. Just a quick strategy with the loan here. You can defer for either 30 days or 120 days. Again, the rate is determined by the amount of money borrowed and the repayment term. We offer weekly, bi-weekly, bi-monthly, and monthly repayment periods, and you don't actually pay any fees if you repay the loan immediately. So we don't charge any fees to pay the loan off like within 2 months or something like that. We don't have any repayment fees. Again, just a few things to know. It can only be used to deposit into an individual RSP, so you cannot put it into, you take a loan from us and put it somewhere else. The RSP can either be in the borrower's name or a spouse's name. So for a spousal, you can deposit it into an existing RSP. However, you cannot draw from that RSP until the loan is fully repaid. So if this is something you want to do in the future, you may want to open a second RSP as well. In terms of doing the loan, very straightforward. You'll just do it online with Evo. So Advisor Center Evo. Simplifying savings on the right, new contract, essentially. So I know many of you have done Evo before. This is quite straightforward. If it's an existing IA client, you can fill in the information and start the application off. If it's a brand new one, just fill in accordingly. Simply put, we would do RSP loan, as you can see right here. Or so, pardon me, choose RSP because that's the type of account. And when it gets to the contribution, you would choose amount borrowed through RSP loan. So just right here. I will again go through kind of a boilerplate disclosure that you should, or sorry, that you have to read through with your clients so they understand that it is there's always risk with leverage, so something to consider here. Go through essentially the principal borrower and all of the details. These are just standard loan questions that we want to go through. There we go. Again, going through a review of assets, liabilities, have they been bankrupt, wage garnishments, so on and so forth. This is just standard loan questions. There we go. Repayment. Again, just kind of standard all the loan and AML questions. So basically quite straightforward. If you do apply for the loan in the next little bit, you'll probably hear back within a few business days. If you try to do your loans the last week of February, so for the cutoff of RSP season, I would expect a week to 10 days to hear back. So earlier is better than later. And again, we are offering a 50 basis point discount on the loan rate from now until January 31. Again, review of assets and liabilities here. So that'll basically cover off the RSP loan. Do we have any questions on this before we continue? Oh, Joanna's asked, does Prestige pricing automatically apply? So it does automatically apply for individual accounts. If you're trying to link like a husband and wife or family together, you do either need to do the form or do the online linking as well there. But any questions on loans before we continue? Nope, pretty straightforward. Okay, good to know. So first time home savings account, we are one of the only essential carriers that does offer the FHSA. This is all done digitally online with Evo, so it is the exact same process, so quite straightforward as well. A few strategies you may want to employ with the FHSA, excuse me, the TFSA to FHSA. So you can transfer this money over and it generates actually another deduction. So if you have 100 grand in your TFSA, you want to take the money out and buy a house, it still makes sense to open an FHSA, transfer some value over and take it out. Because then of course you're still able to generate a deduction and still use the money for a house. Non-reg to FHSA does work as well and is tax deductible. However, of course, it is a sell and a buy when you move the non-registered money, so that's a taxable event. But you do get the deduction when you put it into the FHSA a little bit later on as well. You can also do an RSP to FHSA. There is appeal for this as well because simply put, when you make this change, you don't have to pay the money back to your RSP like you do through a home buyer's plan. So through the FHSA, simply put, you can move from RSP to FHSA, generate a deduction. You don't get restore unused RSP contribution room though, but again, you don't have to pay back to your RSP as well here. Transfer fee reimbursements. If you are ever doing a DSC or sorry, a chargeback business, and the client says, you know what, the bank is going to charge $50 or $150 to bring their money over to IA. If you do an upfront commission option such as chargeback 3 or chargeback 5, we are able to actually reimburse the client from your commission. So you do get a smaller commission, but I always like to say smaller commission is better than no commission because simply put, and some clients will get hung up on $50 or $100 fees, and the banks are charging higher fees right now. So this is a great way to overcome that objection and again, get the client over to IA and under your management as well. So again, it is kind of a way to smooth that discussion over. Again, smaller commission is better than no commission. Oops. Last few things around client support. So we do have the high interest savings account, which continues to be a big seller with us. The rate is presently 2.45%. No withdrawal or management fees. Money's accessible anytime, can be opened on Evo and is available to corporate accounts. You do get a trailing commission on it of 20 basis points as well. It is also available to corporate accounts. So if you're an advisor and you're incorporated and you want to invest your own like retained earnings in there, you do get the interest plus the trailer on it. So it's not a bad strategy. It does count toward high net worth pricing and reduced MERs on seg funds as well. And you can also fund life insurance policies from this as well here. So it's definitely a nice little perk to have. Guaranteed interest funds, if you are looking at insurance GICs, there is a value of doing them over the bank. Yes, your rate of interest is lower, but you have all the benefits of a seg fund. So bypass probate, beneficiary designation, no estate settlement fees, all of the additional perks of it available here as well. So again, for the right client, particularly older ones, insurance GICs do actually make more sense. Because if you pass away, the probate fee will essentially eat up your entire rate of, or eat up, about half of your rate of return today. Rates again here, you're looking at a 1 year at 275 at the middle bracket. So still not too bad. Something to consider again for the right client situation as well here. And we do have special rates over $1 million if it is appealing to you as well. Dollar cost averaging, this is available on a weekly, bi-weekly, and monthly basis from the savings account as well as money market. If you do a dollar cost average from the savings account, your commission, if you choose an upfront option, is paid like a pack. So as the deposits go in, if you dollar cost average from money market, it is paid like an upfront commission. So again, you have both options available to you as well there. QROPs, if you ever have any clients that worked in the UK and they have a pension or their version of an RSP called a QROP, you can actually transfer it to a Canadian RSP. IA is the only insurance carrier in Canada that offers this. The client must be age 55 or older to qualify for the transfer and must reside in Canada with expat status. It is a little bit of paperwork. I would expect probably 2 to 3 months for the money to settle. But again, it's a bit of a niche product, but there is actually quite a bit of money over here. So something to consider as well when you do want to, if you have any clients that have worked over in the UK. Business tracker for savings, something obviously we do want to make sure we're checking on a regular basis for updates with IA. Client Space, you can view your client's documentation online every day through Client Space. So they can go connect, create an account, follow the prompts, and they can view their investments or life contracts every day digitally with IA. So it's a nice little perk to have available with you as well here.
TFSA，然后就他目前的状况就是他和他妈妈每个人会有个 TFSA 开凯，然后是一次性的5000加上每个月500的定存。那么我这个资料呢，所有的信息我都有了。
Mute that. Sorry about that, everyone. Last few things I want to touch on here, just as we come toward the end of the presentation. Through the first quarter of the year, so RSPs, TFSAs, and FHSAs can be funded directly from the client themselves. So if they go into Client Space, click Contribute, click a few prompts, they can do their RSP and TFSA contributions themselves, and the agent of record receives commission. So you don't have to chase down your clients for $7,000 TFSAs or $10,000 RSPs. Just get them to find out their limit, do the application themselves, and they're able to, or not application, just do the contribution themselves, and you as agent of record receive the amount available, or receive the commission on it on your next cycle as well. So it's a great way to generate additional compensation for yourself, save you a lot of work, and also helps your clients get closer to their investment goals as well here. So it is kind of a win-win across the board for all parties. So definitely a tool you want to take advantage of. Comparison. So if you meet a client and they say, you know what, I'm already invested at a bank or with another advisor, say that's fantastic, but you know, we have a very strong investment shelf with IA and world-class managers. Can I offer to do a complimentary portfolio review for you? Take a picture of the client statement, scan it, send a picture of it to myself, please, or whatever you want to do. Please give us 2 business days and we can create an investment proposal for you showing what we offer relative to the other carrier and the advantages of working with IA as well. So this is a complimentary for the client. There's no fee for them to do it. We offer very basic tools like this all the way to very complicated ones. We offer a full range of options. So please don't be shy. Send it to myself or Vincent. Again, 2 business days and we're happy to take care of this for you. Last thing I want to talk about is our business development bonus and the value of it as well here. So this is something unique to IA on the compensation side as well. So we're basically what we do is we are the only carrier in Canada that offers an AUM and in-force bonus when you do business with us based on production. So we essentially calculate it like this. Segregated funds are 2.5% per thousand, right? So 25 credits. GICs are 1% per thousand or for 10 credits. And insurance is dollar for dollar net FYC. If we hit a production target of 42,000 credits, we will get paid an additional bonus of $500 per million in AUM at the bottom and 1% on our in-force block. As we do more business with IA and our tier goes higher, we're actually paid a higher commission depending on our entire block of business with IA as well. So I'm going to give you an example of how that works. So Stephanie is a top producing IA advisor. Okay, she does $2 million a year in seg funds, $2 million a year in GICs, and $60,000 net FYC on insurance. She's going to get paid 3 times, okay? She's going to get paid over here. This is commission leg 1. So she gets her commissions on her seg funds, GICs, and her insurance, net FYC. She also has an $11 million segregated fund block and a $600,000 in-force block. So she gets her trailing commission on her seg block. She's going to get her renewals and her conversions on her 600 grand insurance block. That's commission leg 2. Okay. Because she hit the highest production target with IA, IA is also going to pay her $700 per million in AUM for an extra 7,700, 1.5% on her in-force block for $9,000, for an additional $16,700 in commission. This is commission leg 3. What's interesting about this is this $16,700 does not go to your MGA. 100% of it gets paid to you as an advisor on your code the following year in quarterly installments. Okay, so when you work with IA, you get commission legs 1, 2, and 3. If you work with another carrier, you'd only get leg 1 and 2. So this is again a continuous bonus. It is paid every year that you hit it back to your whole block. We also offer a life insurance bonus called CPB, which is continuous producers bonus. I'm not the expert on that. That would be the life team, but you can qualify for one or both bonuses every year as well. But otherwise, everyone, that will bring us to the end of the presentation as we're coming up to 11:53 here. Do we have any questions before we look to wrap up? Anything left here? Oh, Charles has asked, does the loan need a credit asset or score check? That's a good question, Charles. So depending on the amount of money you're borrowing, the answer is yes. But this would all be done on the back office by head office. So simply put, it would come down, like if you're borrowing $5,000, it wouldn't really be an issue. If you're borrowing 50, they might look at it. It really just is at the underwriter's discretion and it depends on the loan amount and of course the term. Margaret has asked, RSP transfer to FHSA, how long can FHSA be held? I'm not sure what you mean. I guess you're saying, like, do you need to take it out immediately to buy a house? The answer is no. So yeah, you can move money from other registered accounts into the FHSA and it can stay in the FHSA as long as it's open. I believe there is a limit on the FHSA. I think it's 30 years, but I could be wrong about that. I'd need to check. And how to track your commission. You can get a commission report from compensation. So you would just email the compensation line. If you have a question on that, Margaret, maybe if you want to just email me afterwards as well, and my email is up at the front here. But any questions otherwise out there before we look to wrap up the presentation? No, we're all good. Okay, perfect, everyone. Well, thank you very much. Appreciate all of the support. If anyone has any questions or comments, my phone number and email is again up at the front here. I will send a follow-up email afterwards as well, so I'll have Mishi send me everyone's email. And I hope you all have a great weekend, and thank you for all of the continued support. And yeah, have a great weekend, and I hope we enjoy the sunshine today. Take care. Thank you so much, everyone.